Welcome, everyone. Welcome to our discussion on ESG. Potentially, this subject could take an awful long time to unpack, but we've been graciously given 30 minutes. So perhaps rather poignantly, time is of the essence, and we need to sort of crack on with the questions. Before I ask the questions, I would like to just sort of set a little bit of a scene. I'd like to maybe take the first set of questions, a little bit of a retrospective on 2022, and then flip that into the second set of questions, which will then take a more of a future look. So for my first question, looking back at 2022 in particular, but possibly before, could I ask the panelists to give us your views on your ESG journey and any particular successes that you're proud of? Georgia, would you like to answer that one first?
Yeah, so my name is Georgia and I'm the ESG analyst on the Global Listed Infrastructure team at Maple Brown Abbott. I joined about 3 years ago and I'm a dedicated analyst on the listed infrastructure team integrated in each step of the investment process, whether that's investment thesis stage, research, engagement, proxy voting decisions, sale decisions and so on. This year we celebrated our 10-year anniversary for our track record, which is quite something. I only joined 3 years ago, so I can't take credit for that full track record. I suppose the origins of our work have really focused on the governance space in sort of the 5, 6, 7 year, 8 period, primarily because infrastructure companies are at the forefront of regulatory change. Many of them come from prior government ownership, and so decisions that are made today can have significant impacts on shareholder capital over the long term. And so building on that governance side of things, in recent years we've really ramped up our work on the environmental and social side. So the World Resources Institute estimates that the energy sector and its end users comprise 75% of global greenhouse gas emissions. So if there was any sector that was going to be integral to the energy transition and tackling the issues in relation to physical risks of climate change, it's the infrastructure sector. So our work is really focused around energy transition, setting our own emissions targets and also holding companies to account when we think that there may be greenwashing. And in addition to that, in relation to our engagements with companies, we engage frequently with companies. I've just finished a research trip where I met with a number of companies across Europe, one of which I was with for 4 hours. But we like to do deep dives with companies, and so I'd say over the past year, our work has really been about execution. So companies have set targets, which is great, sounds great, looks good on a marketing sort of document and in annual reports. The question is how they actually executing on that, and that has really been the primary focus of our work, because greenwashing is a risk to us as investors, and it is also not good in terms of sustainability outcomes. And then I suppose in addition to that, we've also been really focusing on customer affordability and supply chain issues as well. I think it's really important to not overlook the governance and the social side in favour of the environmental side and have sort of carbon tunnel vision in the way that we think about these things. So in terms of wins, we've had some excellent engagements and outcomes with companies, one of which came to us prior to releasing their remuneration framework because we voted against their remuneration twice in previous years because of a lack of incentivization and alignment on their net zero target. And quite frankly, if a company doesn't have remuneration KPIs to incentivize and align on their net zero targets, then you have to kind of wonder what is going to actually lead to action there. So we've had some brilliant outcomes, but we also try and be balanced and transparent. It's not all sunshine and rainbows. We have good outcomes, we also have bottlenecks. And the question is what do we do when we reach a bottleneck, and what are our next steps? What can we do as an active manager? So I won't pretend that it's all been perfect, but we've certainly made positive steps forward.
Fantastic. Well, thank you. Some great thoughts there. Guy, could I ask the same question of you, please? What's your ESG journey been like, and what happened 2022 and possibly leading up to this, what you're particularly proud of?
Yeah, absolutely. So stepping back, I'm a global listed infrastructure portfolio manager at BlackRock. I've been with BlackRock for just about 5 years now. And certainly you phrased it as the ESG journey. It's come a long way since prior to being at BlackRock. I was actually an analyst on the sell side covering the listed infrastructure sector, working with a large investment bank. And I can tell you at that time, ESG was not a big focus of ours. It wasn't really a big focus of any of the sector teams, to be perfectly honest with you. We had one dedicated ESG research group within the bank, but they operated somewhat independently and didn't really integrate into our space. It was also the case back then, for those of you who were looking at the space then, when it comes to utilities, as an example, it wasn't nearly as exciting a growth space as it is now. It was actually one of the most dreary sectors on the floor. Getting any kind of FaceTime from the sales team or on the morning call was never the easiest. I didn't say this, but I remember being teased by the guys on the oil and gas team that European utilities had outperformed only twice in the prior decade, and they were both down years for the broader market. So it's really nothing to be proud of at the time. Things have really changed since then, and it was really day one stepping into BlackRock. I was working on the global real asset securities team, and now the infrastructure and real estate securities team. And they'd actually integrated ESG directly into their investment process. And this wasn't for an ESG-focused strategy, so to speak, but this was a recognition that E and S and G, because they are all separate, all present real risks, real risk factors to the companies, and therefore should be reflected in the discount rates that we're applying when we're valuing these businesses. And of course, since then, it's increased in focus, largely being client-driven. Clients are more and more asking for sustainable solutions, what we're doing from a sustainability perspective on those dedicated sustainable strategies. And as such, it becomes a part of your fiduciary responsibility to not just be looking at returns, but to be adhering to an entire investment objective and a strategy, which in many cases will also include sustainability. But most importantly, it's really transformed the space in which I'm working because, John was speaking earlier to 8 to 10% asset growth on investment plans that are spanning not just multi-years, but actually multi-decade investment plans. Well, one of the challenges that the space used to face was that it was not the most exciting growth, but it was supposed to have visibility. But really, it didn't have visibility because every so often the government would just turn around and pull the rug out from the businesses. Now, I would say more than ever, governments and all entities are aligned on delivering net zero on this long-term target, and it is a 2050 target, which requires a tremendous amount of investment today, which accommodates that investment opportunities for the companies, for investors, for clients, and of course for the government entities that are setting these targets. So in a sense for humanity as a whole. So it's been a big transformation, I would say, in a very short period of time.
Okay, thank you. Sticking with the theme of respectively looking back at 2022 and the decade leading up to that, I'd like to flip it now and maybe look at some of the disappointments. To help frame the discussion and the responses, I believe we have a slide, hopefully with some couple of graphics on. The slide shows the global ESG indices comparing the MSCI against the GLIO index and also the earnings for listed infrastructure compared to equities. Now, I'm an ESG and sustainability specialist, not an investment specialist, but looking at that, I'm quite surprised that the graph shows quite a lot of variation and a little bit of a decline in terms of the sort of ESG performance. So I'm wondering, I've always looked at sustainability and ESG as just sensible ways to make businesses more efficient, reduce the impact on environment and obviously people, but also make them more productive, both in terms of commercially productive, but also contributions to local economies. So I'm a little bit intrigued to understand what's going on here within these graphs, and maybe for the benefit of myself and the audience here, if you could give me some thoughts on what you think might be happening. Are there any specific issues here or any long-term trends that we need to be concerned with for the future? Guy, would you like to take first stab at that question?
Sure, I'll kick off. And I think it's 2022 that's on the chart. I can't see it perfectly clearly, but I think it's fair to say that 2022 was a highly anomalous year. in general. And you could say the same about 2021, and you could say the same about 2020, I think is fair. But just focusing on 2022, we started out with the supply chain bottlenecks that we saw coming out of the pandemic. Supply struggled to keep up with demand. It drove that pickup in inflation in Q1. And then, of course, we had the energy crisis spurred by the Russian invasion of Ukraine and ensuing sanctions. And that drove an really unprecedented spike in commodity prices, and in particular gas prices. It also drove even higher inflation. And we've all heard and we all recognize that listed infrastructure is a good place to be in an inflationary environment, given explicit and implicit links to inflation and very resilient cash flows in real terms. But that also drove action from central banks to get really aggressive in terms of tightening. And again, a rate tightening cycle that was unprecedented in modern history, at least. So scrolling back to the first point, when you look at different infrastructure benchmarks have different exposures to different sectors. But across the listed infrastructure space, the best performing sector was, you'll guess it, oil and gas, midstream pipelines. That's not always the case, but that is the case in an environment where commodity prices are spiking as much as they did. So midstream was up probably about 30% in aggregate, depending on how you shape the space. That contributed, well, varies based on the benchmark, but maybe it's 10% of the FTSE Developed Market Infra benchmark. Maybe it's more like 40% of Dow Jones Brookfield. It has a big impact. So sustainable strategies wouldn't tend to invest in midstream oil and gas, and therefore they wouldn't necessarily participate in that performance. The second thing on real interest rates, look, we're talking about very long-term dynamics, long-term investment cycles, long-term themes. And as real interest rates rise, rising real interest rate tide, so to speak, sinks all asset values. Now, we do have some protection within the listed infrastructure space, given periodic price control reviews, for example, for the utilities, and the way that PPAs are signed on the renewable side and the way concessions are structured as well, but nonetheless, still going to be affected there. What I would say, though, is I'm not expecting an energy crisis every single year going forward in terms of whether this is an anomaly or something that we should expect as a sustained dynamic. I don't think anybody is expecting an energy crisis like the one that we saw in 2022 every year going forward, nor would we expect such an aggressive hiking cycle from central banks. In fact, we're starting to see inflation indicators come down, and we're starting to see the impact on the real economy come through. And that's where I think the resilience of infrastructure cash flows will really come to light. When we talk about sustainability, sustainability from a climate perspective in terms of the investments that are required now to deliver net zero in 2050, are investments that are going to be delivering consistent cash flows over that period. They're regulated streams of cash flows or contracted streams of cash flows. In a broader market downturn where you might anticipate certain sectors in the broader economy to see downgrades to expectations of the earnings that those companies are going to deliver, I think what you'll see is that the listed infrastructure space can be far more resilient. I also, when we talk about broad ESG, perhaps the final thing I'll say, there has been quite a bit of crowding in terms of some of the investments that have been made, and I guess we'll get to some of the regulatory dynamics shortly. But we've done some analysis internally on our team, and when we look at some of the top holdings amongst the biggest ESG-focused funds, we don't actually see any listed infrastructure in the top 10 most crowded positions. They do tend to be exposed to different types of sectors. So it's just worth touching on as well when you look at the GLIO ESG index. It certainly performed better than what you see from the MSCI World ESG.
So listed infrastructure is still a safe investment, and you're predicting it to continue to be so, and no real issues. Is it a question of just the measurements, or the metrics, or measuring the right things? Is perhaps a follow-on question.
I think so, and I think there's also just a period of time issue. It was touched on earlier that listed markets aren't always rational over the short term. They trade on sentiment. There were some really significant sentiment swings over the course of 2022. And I hope to see further sentiment swings going forward, because that's precisely what creates alpha opportunities for active managers. But I think over a longer term view, that sustainable, resilient cash flow profile is what's really going to come through, and the inherent value of these assets, which largely unscathed by the events of 2022.
Thank you. Georgia, would you like to give some reflections or thoughts on the indices and the performance generally?
Yeah, so it's a really interesting chart, and it's a bit annoying in many ways, because we've read, I'm sure you've all read so many headlines to say, it's the end of ESG, no more, market is backtracking. And I just have to say, it's so short-termist, and we have to rethink what we're referring to when we talk about ESG. When we think about global equities, ESG indices, you've got to ask the question, like, what's in them? And when you look at the most commonly held stocks in those ESG or sustainable funds, they're healthcare stocks and they are tech companies. They're very, very growth-oriented. Why they're in there and why they're the top 10 holdings is a conversation for another time. We have to think about what's influencing the creation of those indices, which the creation of indices is actually very pertinent, of course, to our sector in the listed infrastructure space. What's driving those indices? So I think it's worth remembering when all the headlines talk about ESG underperformance, we've got to go back to basics here as to what we're actually talking about. Are we talking about ESG integration? Are we talking about screening? Are we talking about sustainability impact strategies? There's a whole plethora, and there's no agreement on what it means. And that's actually a good thing, because that means that there's optionality in the market for all of us as investors to invest in the things that we are most interested in, aligned in. We believe the opportunities and the risks are there for us to choose from. I think also the challenge is, of course, is that for us, with the construction of these indices, these are point-in-time ratings or pieces of data. They don't give us any look through about the change of these companies. And for infrastructure assets that are long dated and these have long capex spending plans, the question is where are they today and where are they going to be into the future? And the rate of change is, from our perspective, the most important aspect. Is it ambitious enough? What is underpinning your target or commitment? How is capex earmarked and aligned? How is that disclosed? What's incentivizing you? What carbon prices do you use in your project hurdle rates? Does your board risk appetite statement integrate climate risk into it? How is that risk categorized? Is it reputational? Is it financial? Is it credit? There's all these questions you have to ask yourself. So going back to the initial point here, I think we need to think a little bit more long-term about the role of listed infrastructure, rather than just applying this sort of very blanket black or white thinking of, yeah, that's the sustainable stock that will go in the fund, that won't, without any view as to what the next few years hold. I wish, wouldn't it be lovely if we could divest our way towards the energy transition? Wouldn't that be just so easy? But it's just not the case. I think the other thing to mention with listed infrastructure is that these are typically defensive assets. So if there was ever a time, if you wanted to invest in the sustainability or ESG theme, to look for infrastructure is that type of exposure, because that's what's going to diversify any sustainability or ESG exposure you might be seeking. And the ESG funds have really lost out over the past year because of a lack of diversification. In terms of flows, it's really interesting because some of the Morningstar reports, again, is sort of, not Morningstar aren't saying this, but markets are saying, oh gosh, ESG flows have really subdued. But they've actually been far more robust than the non-ESG space. In fact, they've massively outperformed. So let's also just keep that in context there. I think also just on the invasion, Russia's invasion of Ukraine, we've also heard a lot of headlines about a coal renaissance. The latest IEA coal outlook for 2022 shows it's actually more muted than was originally anticipated. Again, short-term thinking here. These headlines are all very nice and they're easy to read, they're good sound bites, but again, what is going to accelerate decarbonisation? It's the Inflation Reduction Act, it's that 360 billion inbuilt into that act. It's Fit for 55, it's Repower EU, it's accelerating this space in terms of energy security and energy affordability, and that trilemma is absolutely integral to the way that we're looking at the listed infrastructure space. So I could clearly talk about this forever. and it clearly riles me up. But I think there's more than meets the eye with this chart.
Okay, thank you. Trust me, it does me too. If I could just put a personal comment, I think some of the sort of backlash on ESG tended to come from the North America. So I think there's a bit of politicization against ESG, but I won't get into that right now.
The last point really is important, though, that we saw these short-term events, short-term issues, but really what that did, you touched on the Inflation Reduction Act, and we had Ursula von der Leyen also speaking to a very similar proposal here in Europe. It's actually accelerating some of the sustainability dynamics over the medium and longer term, despite that one challenging year that we had as a consequence of that year.
Okay, thank you both. Still keeping with the theme of sort of a reflective. Last year saw the introduction of some notable bits of regulation, so SFDR and EU taxonomy, for example, obviously being introduced in order to create a new regime for investor disclosures with the intention of directing capital flows to ESG investments and reducing greenwashing. Of course, in the UK, we also have our sustainable disclosure regulations currently being consulted on, so that's coming down the pipeline very soon. And of course, for those in the UK, all UK enterprises need to be aligning with TCFD regulations specifically. So with those sort of legislative drivers in mind, could you give us your thoughts on the legislative drivers and maybe reflecting on some sort of positive comments or negative comments on as you see fit from your experience? Guy, would you like to go first?
Sure, absolutely. I think a lot of this comes back to something that I was saying earlier in terms of the drive for ESG really being client-driven. And so I think we have to welcome these new regulations for disclosure, which are coming into place, because done right, it should make our jobs easier. We've struggled with data issues in the past, more on the private side than on the listed side, but nonetheless, sort of from famine to feast. But it's a question of getting all of the right data in place and the data that we actually need to properly make the assessments that we need to make. So excellent initiatives. And implementation, as you would expect, is not always the easiest thing. And I think it's a challenge from all perspectives, including the regulatory authorities themselves. And I think we can see that just by how long the EU taxonomy has taken to really be implemented and be put forward, by the, call it back and forth a little bit that we saw last year in terms of treatment of things like gas and nuclear, but also just integrating it into process. There are, of course, costs and benefits to being part of a large institution like BlackRock. One of the benefits, of course, is we have dedicated teams to deciphering all of the data and the requirements that are needed under SFDR, under the EU taxonomy. But certainly it's created some challenges from that perspective. I think what it's really done, which is important though, is it's shifted everybody's focus even more towards sustainability. And that's for the companies that are having to report under these new guidelines as well. It's not just coming from engagement from their investors anymore. It's new disclosures that are having to be put forward. And that really brings to mind, where am I deploying capital and what's that going to mean for things like my forward emissions, for my carbon mitigation outputs and my carbon reduction outputs, for example. And I think we're seeing that in real terms. I mean, John was speaking earlier today about some asset rotations that they've done over the last couple of years, which have directed more of their assets towards electricity and less towards gas. We're seeing across the space, especially, it always seems to start in Europe, and I think there's a broad hope that the EU taxonomy, becomes a benchmark for what we might see on a more global basis. But the decommissioning of thermal assets, or at least mothballing, again, coming back to 2022, some had to start back up, but the longer term accelerated decommissioning schedules of some of these thermal plants and accelerated plans for rollout of renewable energy and investment in the infrastructure which is required to really deliver upon those assets is a really positive thing. And I think it's not just from these regulations, it's also the new legislation that we've seen passed. And one of the things that really encouraged me just last week in terms of the discussion of the Net Zero Industrial Plan for Europe, which is kind of the response to the IRA, is point number one of the four-pronged plan wasn't financing. It wasn't just throwing money at the issue, because people in this room will tell you there's plenty of capital that would love to finance these projects. But the two things that we heard from National Grid are very consistent across the industry in terms of what are the impediments. Well, number one, it's permitting. And number two, it's grid constraints, supply chains being number three. So regulation being the first point that was brought forward by von der Leyen on behalf of Europe, in terms of something that's going to ease going forward to facilitate the transition, I think is incredibly encouraging. I think the authorities are starting to focus on all the right issues right now, but we're in that transition period, and certainly there are always speed bumps along the way.
Yeah. And certainly from a personal perspective, the clients that I talk to and the thing that I note particularly is that it's the requirement to disclose requires you to be very clear and concise about what you're disclosing, which requires you to think about metrics, targets, but crucially, not having long-term targets, but actually having targets that you can implement today. So backcasting from that 2050 target, say, for climate change, and backcasting it on a yearly basis. What are you doing incrementally year on year to get you to your end goal? So I think I noticed that is a particular thing that comes out of the discussions I have. It's forcing that, bring it back into the day's actions. What are you doing this year, next year, year after? Georgia, could I ask you the same? Any reflections on TCFD, SFDR?
Yeah, there's been so much change. When you think back to, say, 5 or 6 years, you just wouldn't think that we are where we are today. And I suppose people tend to be surprised year on year and call each year unprecedented, but I think we just all have to accept that this is the direction of the market, and you either get on the train or you miss the train. On the TCFD side, look, it's great that we're aiming to get more transparency and disclosure and reporting. And jurisdictions are making it mandatory all around the world. New Zealand, the Australian regulators are sort of hinting that it might go mandatory. The UK, as you say. I think it's not really a question of do you have a reporting on TCFD or a TCFD report. It's more a question of what's in it, because the quality of TCFD reporting is either excellent or it's just, to be honest with you, it's meaningless. Sometimes you might see companies really just summarizing what the models are telling them, but not actually talking about what those models mean when it comes to their transition stress testing, or how it informs their CapEx spending plan, or how it informs their risk management frameworks, or how it's actually changed their thinking about certain segments of their business. And that's where the rubber hits the road. Like, if you don't have that detail, well, to be honest, it's a massive waste of resource. We'd rather that the company didn't bother doing it in the first place. But there are companies that do an excellent job, and they're clear on their methodology, and they're clear about what they've done with that analysis to inform their next steps. And they use that analysis and they update it annually, and they're clear about, I suppose, the implementation. I think also it's really important to remember that the TCFD is inward-looking, so it's not a sustainability-focused framework. It's talking about risks and opportunities to the business, and that's where something like the taxonomy is completely different. The EU taxonomy looks at economic activities that are contributing to sustainable outcomes. One is inward-looking, one is outward-looking, and it's quite nice to see a bit of diversity in some of these regulatory frameworks to encourage both of those perspectives. Just back on the TCFD, I think it's also worth considering what's actually missing from the TCFD report, because sometimes a company might just suspiciously leave out a section on gas demand when they own a gas distribution business. And then you've got to ask this question, so it's not so much what's in it, but what's not in it as well. Taxonomy, look, it's great to have consistency. It's all a bit of a muddle at the moment. I met with about a third of our portfolio companies over the past fortnight, and I think one of the key questions is what's this actually going to mean for you as a business? What does the taxonomy mean? Does it change the way that you can secure debt? Does it change your insurance premiums? Like, what does it actually translate to? And I think the resounding answer was companies just don't really know at this stage. So we're still sort of feeling our way through, both as investors and companies themselves. But the important thing, I think, with the taxonomy is that companies work with third-party data providers to actually make sure that the data that third-party data providers are using is accurate, because a lot of third-party data providers use estimates, and sometimes even the fundamental aspects can be flawed. So CapEx OPEX revenue numbers might be incorrect, and that's not reflected and makes some funny skews in numbers. So it's really important to make sure that we're working from the same sort of baseline. But probably the bit that I also find intriguing is that the taxonomy actually has cross-jurisdictional implications. If you are an investor in a UCITS fund, you're a fund manager of a UCITS fund, some companies might be mandated to report on the taxonomy, but some companies are not. And so the question is actually trying to encourage those companies that are not mandated to produce reporting to ensure that there are not inaccurate estimates out in the market. So I think that's quite an interesting aspect of the taxonomy. I think the other thing that we need to just mention here is, if we're talking about the US, for instance, is the SEC's proposed rule on climate-related financial disclosures. That was a proposed rule that was put forward at the beginning of 2022. We put forward a comment to the SEC in favour of that proposed rule plus more. There will hopefully be a decision on that proposed rule later this year, but it's really about trying to find some more consistency in the ways that listed companies or companies regulated by the SEC report on things like emissions, climate risk, and so on. So lots of regulatory change to come, but it's all indicative of just the way that the market is moving and the signals that are pushing in that direction. Yeah.
Very good thoughts. I mean, it's clarity of what you're doing, what outcomes you're measuring, and data quality. We are undoubtedly in a world driven by data, so I think it's going to be an increasing theme of ESG in the years ahead. So now moving towards sort of some thoughts to 2023 and beyond. Given that we are experiencing a global crisis, shall we say, with current geopolitics, what are your organisation's priorities for 2023 and beyond? And have they been impacted by the current geopolitical situation we find ourselves in? Guy, would you like to have a stab at that first?
Yeah, I'll speak to my team rather than sort of the broader organisation. But absolutely, coming out of 2022, it's the more things change, the more they stay the same in a sense. I think we used to speak coming out of the COVID pandemic that the real effects were simply accelerating existing trends and existing dynamics, which were already in place before the pandemic. And I think what just going to call it the energy crisis of 2022, it encapsulates a lot. But I think that's done something very, very similar. We spoke earlier of the energy trilemma, trying to balance affordability with security of supply, and also, of course, decarbonization. And for most of my career, those three aspects were completely inconsistent with one another. You couldn't have all three. Suddenly, you can. Like offshore wind in the UK, we're targeting 50 gigawatts by 2030. And say what you will of the achievability of that target, but having that target in place is precisely what's needed in order to facilitate investment in the infrastructure required to get there. So you'd rather have. But the point is, we saw the offshore wind auctions in the UK last year, and it was completely unprecedented. They cleared it, I think it was £37 per megawatt hour, which was lower than where baseload power prices were before the energy crisis. Suddenly it was much, much cheaper to develop energy from offshore wind than it was from coal or gas. And that's not something that anybody would have predicted 10, 15 years ago. 5 years ago. Solar is now the cheapest form of electricity. So a long way of saying, suddenly affordability fits with decarbonization. And security of supply, we have issues of intermittency, of course, but at least with renewables, we're not dependent on imported fossil fuels. Now, speaking of priorities for 2023, I think that just kind of bringing together from an investment perspective where our focus is, and it's aligning not just the ESG element of things, but also the fundamental change in dynamics that we're seeing, and ESG-related risks on long-term cash flows from some of the businesses, which may have some impressive ESG or climate-related targets in place, but without the short or the medium-term detail to get there, and without the credibility when stepping back and we look at how is this oil and gas pipeline business going to deliver net zero, are these assets really fit for purpose in a very rapidly changing world? I think just integrating more and more of this into our process and being as quick as we can be to sort of integrate these changes and be ahead of the curve. I think the second thing is ESG demand is steadily increasing. Those charts aside, there have been significant ESG inflows even over the past 12 months or since January of 2021, and we don't see that demand wavering. So it's just going to be a question of ensuring that we are delivering upon the ESG-related objectives of our clients while also maintaining our ability to deliver on the return objectives and ensuring that we're sort of true to our principles. We didn't really touch on SFDR too much, but SFDR is one area where there's an element of leeway in terms of what is sustainability. Every investment needs to be sustainable, and from that perspective, we just need to ensure that we're sticking true to our principles in terms of what we're delivering from a sustainability perspective, staying true to client objectives as well, and delivering on across all of those responsibilities.
Carry on and possibly even accelerate what you
I think
already
it's a summary.
identified as being the priorities.
Absolutely.
Yeah. Georgia, any reflections from you on priorities? Have they changed?
Probably summarised in 3 ways. The first one being that I mentioned this earlier, but we tend to have a bit of carbon tunnel vision, and it's really important to focus on the governance aspects as well, because you can have a green or clean company that has all the right credentials, but when the governance aspects fail, it becomes irrelevant. You can have companies that that fit that green sort of box, but then on the governance side are really not that strong. So for us, I think governance continues to be, and will probably actually heighten our focus. We've heightened this year, particularly on things like political lobbying, political lobbying expenditure and policies. And actually, this is something that we wrote about in the latest GLIO journal with a spotlight on US utilities. And also with a spin on that on terms of climate-related lobbying. So how companies' lobbying activities, whether that's direct or indirect lobbying, align with their positions on climate change, because that's also a source of disconnect that we worry about. In addition to that, remuneration frameworks, ongoing alignment, incentivization, appropriate remuneration frameworks, excessive pay, but also, as I said, alignment with a company's stated target, if that is on net zero or business strategy. The second one being is that it's increasingly becoming clear that the world's ability to reach the long-term temperature goal of the Paris Agreement is becoming even more unlikely. And with that unlikeliness comes an increasing risk of physical risk, more extreme and frequent weather events. And so focus on that with companies, but also looking at ways in which they're investing CapEx to harden their assets, build resilience, whether it's undergrounding cables, whether it's looking at natural capital solutions to provide resiliency as well. So that's a second focus. And then the third one, I think, is just plain and simple execution. It's just ongoing execution of companies and what they're doing, what they say they're doing, and equally us with our execution of what our commitments are to our clients and delivering on our investment objectives. So yeah, probably say that those 3 things: governance, physical risk, and execution.
Okay, thank you. Conscious of time, and hopefully to end on a positive note, a final question for you both. Could you share with the audience any top tips that you have on your ESG journey and how to go about delivering on ESG, hopefully for the better? Guy, would you like to go first?
You know what, I think it comes down to the final thing that I said, which is really just having a clear set of principles and sticking to those principles. Different people have different perspectives on different elements of ESG, so you really need to understand where you sit and stay true to those core principles.
Okay. Georgia.
Yeah, I think my top tip is just to never take a statement, commitment, or a target at face value. The devil is in the detail. It really is, and we can't just take these things at face value and accept them, because we wouldn't be performing our fiduciary duties on behalf of our clients if we just accepted everything we read. And so my top tip for both clients, consultants, and investment managers is just to really look under the hood. I think the second one I'd say is, again, just focus on, don't overlook one factor in favour of another. Balanced approach, I think, is really important. And I know I've kind of gone on about that point, but it's important. And then the third one I'd probably say is for companies we need consistency of data and reporting, and the e-taxonomy is incredibly critical for us as investment managers and companies themselves, and getting it right will take some time, but for those companies to make sure that the right data is out there and the estimates aren't being made, even companies that are not mandated as well, because the more we're using the same sort of baseline, the more efficient basically it all becomes. So yeah, those are my top 2 tips.
Thank you. I totally concur. Data is going to be very important, data quality. Especially so, I think as one of the older people in the ESG arena, because I've been in the industry for over 35 years.
You're a unicorn.
I am. But I can definitely see, and certainly my colleagues who are younger and they do not take, they don't take it lightly. They take it very seriously. And I think that's a generational switch, which is really important. They will dig into the detail. They will ask you the hard questions, rightly so. It's their future. So I totally concur. It's going to be about data, proving what you say you're doing, not just offering warm words. But